The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 15th of August. Jeremy, welcome back. Good to have you here.
Hi, Gareth. Yeah, good to be here.
So it's felt like the traditional quiet summer UK market lack of activity. Has there been much that's excited you in the UK this week?
It's a bit like sailing in the doldrums, really. Yeah, it's pretty thin gruel out there for anyone trying to ascertain the overall health of the UK stock market at the moment. But in the States, the reporting season has seemed to demonstrate a much clearer picture of health, I would say. So, in the UK particularly, it feels like companies are hanging on in the hope of better times ahead. And those better times ahead don't seem to be currently imminent.
No.
Albeit the macro data, the UK is showing more resilience than perhaps the worst fears.
But it does feel like we're heading into a long protracted autumn of waiting for the autumn statement, doesn't it?
Yes, the autumn statement that's due in midwinter, yeah. It's going to be a long haul for the third quarter, I think, yeah.
It is.
And overall, last week, we've seen higher stock markets overall, UK and US. We've seen a weaker dollar overall. Should be good news for the rest of the world. But we've also seen pretty volatile bond yields and volatile bond markets, largely reflecting sort of conflicting evidence out there for the outlook for US inflation. But of course, the big political news is today's meeting in Alaska between Trump and Putin.
Yeah. Wait and see whether that delivers anything. Yeah.
And in the UK, the main political news seems to be that J.D. Vance has been caught fishing without a license.
Well, I understand they bought them. They both bought fishing licenses retrospectively. So it's all fine. Don't worry.
And on the financial pages, I think the focus has been speculation on the main tax proposals that we can expect in the budget, which seems to basically focus on increasing taxes on gambling, and increases in inheritance tax also look likely.
I even saw something a couple of days ago about the fact that they might do something with VAT, which would be a very obviously wide-ranging and potentially frustrating change to be working through. Lots of red tape and admin goes with any change on VAT. But yeah, if we get into that situation, same as last year, everyone will be wondering what's coming, worrying about how that might impact them or their business. And in that environment, people just sit on their hands and wait, which is a very bad place to be. So again, not good.
But in the meantime, I'd say the macro data this week for the UK has been poor, but not calamitous.
Okay.
So we got relatively stable employment data signalling a moderation in wage growth, then followed by news that the UK economy grew in the second quarter by 0.3% versus the expectation of 0.1%. But quite a sharp slowdown from the 0.7% of the previous quarter. So slowing but not collapsing. And in the pack of the G7 league table, okay, but investors are sort of basically looking for evidence of the impact of the Trump tariffs on inflation and growth. Got very mixed messages this week. But judged just from the perspective of equity markets, there's nothing to worry about at all. I mean, the S&P 500 rose 2% on the week to an all-time high, and the volatility measures all fell. And, just looking back on where the stock markets have got to from the low in early April, the US market is now 30% above that level, compared with a FTSE that's up 18%, a UK 250 that's up 23%, and an AIM market that's up 21% from their lows. Nothing to worry about here.
No, it's easy to forget how strong those markets have been, isn't it? Yeah. I mean, it's just, in the space of 4 months, it's a phenomenal performance. So certainly shows that the equity investors think things are pretty rosy. How long that will last, hard to see.
I think part of that is, the equity markets looking forward and into a future where the bond and yield and currency outlook and maybe the financial conditions outlook will be much looser, i.e. a lower rate environment. But back in the US, in terms of the macro data, Tuesday's inline and unchanged inflation print of 2.7% was a cue for Scott Bessent to pile back into the Fed Chair Powell, advising him that the FOMC should consider 50 basis point cuts and that overall policy rates should be substantially lower. So continuing to tell the FOMC how they should be doing their job. And taking the more direct approach, Trump let it be known that he's considering suing Fed Chair Powell over the mismanagement of the renovation of the Fed's headquarters. So the pressure is really being applied here. But on the back of that relatively benign inflation print, albeit still above target, by Wednesday, markets had priced in a 96% chance that the Fed will cut rates next month. Mm-hmm. The dollar fell and everything seemed to be on track for lower US rates. But things changed yesterday when we got a much higher than expected wholesale inflation print, the PPI data, which accelerated in July by the most in 3 years, suggesting companies are beginning to pass along these higher import costs related to the tariffs. So the Trump haters, if you like, have now found their smoking gun. There is now the first piece of real evidence that there is a fuse for reflation in the US economy. So yields rose and the expectations of the rate cut that looked near certain has come down. I mean, it still looks odds on, but it's now come down. So I think there is a chance here, Jay Powell, if he's got the stubbornness and mindset to do it, can dig in here. And there could be sufficient data come September that inflation is resurgent, the economy is in an underlying sense still quite strong, for him to hold his ground and not cut rates at the next meeting. And I think that's going to be fascinating.
That would obviously infuriate Bessent. If Bessent's saying it should be a 50 basis point cut and Powell manages to achieve 0, then that would be quite a big signal. I think you've mentioned previously that the PPI isn't normally a hugely followed or super important number. Is it in any way sort of a leading indicator?
In theory, yeah, it's the producer price index. Yeah. So downstream of this should be retail price inflation. Now, the question is the degree to which the producers and the wholesalers and the distributors and the supply chain eats the price increase. So it's not a foregone conclusion that this will result in higher CPI, but yeah, it certainly changes the odds. And it does look as though this could be a setup for an almighty showdown between the White House and the Fed.
Well, it's much more interesting than sitting in the UK waiting for our autumn statement.
Yes. I mean, Powell's gone this time next year, whatever happens. Yeah. So I think he's going to be focusing on protecting his legacy. He wants to go down in history as someone who managed to control inflation. He wants to be more of a Paul Volcker than an Arthur Burns.
Okay.
And I suspect he will also be looking forward to taking some comfort from his fellow central bankers at their Jackson Hole retreat in a couple of weeks' time.
Yeah.
So what have you been looking at in the UK this week?
So yeah, the UK small micro cap market is another interesting week. We've had a few bits of company news. We had an interesting set of results from Xaar, which is a manufacturer of print heads for industrial printing and industrial printing applications. They had H1 through to June. So they had revenue up 7%, of which print head was up 20%. So some really quite nice growth coming through. One of their small niche markets, actually jewellery wax, which most people wouldn't have thought of as a key market for industrial printing. It's a niche market. It's actually relatively large, and that's contributed nicely to growth across that time frame. So Xaar has had a history over the years of finding some really quite significant market opportunities for its broad range of products. And it's a nice first half from Xaar, and hopefully more to come across the back of the year as maybe one or more of the other markets start to motor as well. So that was positive. Then we had Zoo Digital. They gave us their FY25 results at the end of March. They've been really suffering in recent years. This is a provider of translation, subtitling and dubbing into the market for mainly video content, sort of streaming video and other types of video content. And they battled over the years with the writers and actors strike in the States, obviously post-COVID. There's been lots of M&A in the customer segment, so lots of confusion and disruption amongst the buyers of their services. And then more recently, the advent of AI, a number of investors are worried what the impact of that will be on Zoo's business. So it's been a challenging time for them. They've managed costs down. These results were in line with a previously reduced set of outlook for the year to March 25. And we've managed to maintain our forecasts for the year ahead. So it feels like they're managing the business well. And hopefully, if the market does start to recover in any way, they're well positioned to deliver against that. So a good set of results from Zoo, all things considered. You mentioned you've been looking at Shoezone. It's quite a difficult statement from them in terms of a trading update.
Shoezone basically said it had experienced a very challenging trading period, principally driven by a further weakening in consumer confidence, which they firmly put the blame at the feet of the government's budget from last year, and said that it had experienced less discretionary spend with continued impact of inflation, interest rates and higher savings rates, all of which has decreased footfall, which resulted in a reduction in revenue and profit. So, a pretty disastrous profit warning, all told. And they basically said that PBT for the year to September is expected to be half what they previously had guided to, and that it was withdrawing its dividend policy. So, pretty alarmist stuff. But as you know, I'm very much a back of the envelope person when it comes to analysing companies. But I reckon the market value now, the EV, the all-in value of Shoezone, is probably not too far distant from the value of the inventory it carries on its balance sheet. So you basically got a profitable business, albeit very marginally, in a company that is, at the lower end of the market, but actually probably a tenant that is of improving quality as far as landlords are concerned. I think its average lease length of its store portfolio is less than 3 years. So while it has lease obligations, it doesn't have any other forms of debt. It is more in control of its own destiny than the market value would indicate. Now, that's my hunch. So could be wrong. Could be on the verge of something far worse than what it's reported just here. But usually in these sort of situations, things aren't quite as bad as people fear. And who knows, the management have quite a large holding in this company. So I think there's a strong incentive from within the business to salvage value here.
Okay, great. And what about next week? What have we got coming up for the next 7 days?
Well, we've got UK inflation for July. Now, hold on to your hats, because I think it could start with a 4.
4% plus, you mean?
Yeah. Okay. Inflation is rising and could be running at more than twice the targeted level. And if that is the case, this will be the 49th out of the last 51 monthly inflation reports that are above target.
And this is in a world where UK PLC is looking forward to the interest rate cuts that are needed to stimulate the economy. Okay.
Yeah. We've also got minutes from the FOMC from their last meeting, which I think should be illuminating because it was a pretty hawkish decision not to change rates. And we also next week on Friday get inflation for July from Japan, which is going to show an unchanged rate at 3.3%. Now, we had this week Scott Bessent not just advising his own central bank what they should be doing with their monetary policy, but also offering advice to the Bank of Japan about how they should be managing their monetary policy. But such is the way the world is moving at the moment. But of course, the big thing looking ahead is the implications of what happens today in Fairbanks, Alaska, with the meeting between Donald and Vlad, and how they're going to move the lines on the map in Europe going forward. So we all wait with bated breath to see how our part of the world is going to shape up onto this new world order.
Yeah, it would be wonderful if they can get some kind of positive momentum out of those talks. So fingers crossed for that. Good stuff. Okay, great talking to you again, Jeremy, as usual, and we'll catch up this time next week. Talk to you then.
Look forward to it.
Brought to you by Progressive Equity.